All right, all right, all right. This is the last part, and maybe the last video, since I'll be able to make all the other classes, unless Southwest destroys me someday. All right. So the last part we're going to cover is exempt organizations, and it's not entirely new to the CPA exam, but given the redesign, it's given a much higher profile than it ever received previously. And it's down in the core where one might have expected it to be up in the specialization area, but it's not. So it's hard to know exactly what we're going to see. So I'm going to give you a bit more than Gleim does, although they give quite a bit as well. And I'm doing that just to be safe, because if I could predict exactly what was going to be on there, I would do so. And I think there'll be some elements of it, and I'll emphasize those as we walk through this last video. So obviously, an exempt organization is designed to be exempt from federal taxes, but they're not always are actually exempt, and we'll see how that occurs. So exempt organizations are subject to subchapter F. That's the 500s in the code sections. That's not subpart F, right? Subpart F income is that form of international income that's subject to U.S. tax, even when it's not brought home. Anyway, not relevant. These are the 500s. And exempt means, what is that? I guess really when we say what does exempt mean, what we really mean is what is the value of being an exempt entity? Well, first off, charitable contributions are deductible by donors. So that means you can take money from people and they can deduct it as an itemized deduction on their taxes, or if it's a corporate taxpayer, as a corporate charitable contribution. Interest is tax exempt for bondholders. So to the extent you float bonds and you're an exempt organization, the bondholders do not have to pay tax on that item. You may pay no income tax. Now that's possibly, and we'll see why that's only a possibly, but if you organize things just so, then in fact you'll pay no income tax. You may be exempt for state income and property taxes. So of course all states vary, and with respect to property taxes, the same, but it's pretty common for most states to exempt organizations from both state income and property taxes. And you enjoy a discount on mailing rates. Yay! Have you ever seen that bulk mailing rate on a piece of mail? That's often because nonprofits get a cheaper rate. Okay, so as you can see, we're used to hearing about the 501c3, the public charity, but you can see there's a large number of possible exempt entities that are available. And I didn't even list them all, right? There are others, the 501k for childcare, 501n for charitable risk pools. Now we're going to focus on the 501c3s, but don't think that you couldn't necessarily specialize in any one of these. And social clubs, there's lots of those around, credit unions. The world used to be full of mutual insurance companies, but they all got demutualized, so not so much anymore. But the point is there's just a bevy of different 501s that are available as exempt entities. And the rules for qualification differ slightly. So again, this can't be a class about exempt entities from beginning to end, which we could spend, I think, a whole quarter on nothing but that. Okay, so how do you get exempt status? Well, you request it, right? You file for a request of determination of exempt status. So the first is like the simple page. So if your assets are expected to be valued at less than $250,000 and your annual gross receipts are $50,000 or less. So this is your basic kind of booster club for a high school team or Little League or something like that. So a fairly small exempt status organization. You can file a 1023 easy. It's only 3 pages long. Submit that to the IRS and cross your fingers and hope for a good determination. Otherwise, if you're a 501c3, an E, F, K, or N, you file a Form 1023, and that's a 26-page form. So clearly much more serious about providing information to the IRS to let them know exactly what it is you're doing so that they can make a reasonable determination. And then for some of those other more esoteric exempt organizations, you file a Form 1024, and a 501c4 files a Form 1024A. And if you've never seen those, go out to the IRS.gov website and take a peek. see what these forms look like and the type of information they ask. And if you're really keen, go and look at the instructions for these forms. So I'll tell you, I know at least one of you, one of the people in this class is going to Moss Adams. Moss Adams has an extensive exempt entity service operation, right? The big firms don't do a lot of this except kind of on the side pro bono for some of their clients that are mixed up in these. But medium-sized and small firms do a lot of work in this area. And so if that's you, you might want to go take a look at these forms. Okay, so the distinguishing feature of a tax-exempt organization is their pledge to serve the welfare or convenience of a wide class of individuals or organizations, rather than to enrich the individuals running the organization, such as employees or shareholders. And so in order to achieve exempt status, you must satisfy both the organizational test and the operational test. So the organizational test is one in which the service, because they have to look at how you're being organized, is going to rely heavily on the articles of incorporation or organizing documents that you're going to have to submit as part of that application for exempt status. So it must show that it limits the purposes of the organization to one or more exempt purposes and does not expressly empower the organization to engage other than as an insubstantial part of its activities and activities that in themselves are not furtherance of one or more exempt purposes. So the organizing documents have to be crafted in a way that show that, look, this organization is really driven to only engage in these exempt purpose activities. It must state unequivocally that is being formed or organized for one or more of the exempt purposes mentioned in IRC 501c3. That is for religious, charitable, scientific, literary, or educational purposes. It must not expressly permit the organization to carry on activities that do not further that org's exempt purpose, except where those non-exempt activities are an insubstantial part of the organization's regular activities. And it must not authorize it to devote more than an insubstantial part of its activities to influence legislation, that's either directly or indirectly, or have objectives and engage in activities that would characterize it as an action organization. And it must provide that its assets must be dedicated to an exempt purpose. All right, so what is the operational test? It must be, this is the second test, sorry. The operational test, it must be operated exclusively for the prescribed exempt purpose. It will be regarded as operated exclusively for the exempt purpose only if it engages primarily in activities that accomplish one or more of these exempt purposes. So like the organizational test, an organization is not regarded as exempt if more than an insubstantial part of it, insubstantial, man, I got to work on my language this morning, is not in furtherance of the exempt purpose. So the operational test is something you can't really observe, right? That's something that, meaning at the point of determination. This is something that is examined, if you will, as a function of the way the reports are provided to the IRS when they report year-end for tax purposes, and also if they're pulled for audit, of course. So they must follow the primary purpose doctrine. So again, for a 501c3, required to be organized and operated exclusively for that exempt purpose to qualify for tax-exempt status. Is interpreted as engaged primarily in the activities, right? So there is some slippage, right? You're allowed to be involved in some other activities, but you must be engaged primarily in activities that are furtherance. So one of the things that will cause you to lose your exempt status is if the organization is providing inurement to private individuals. So this would be if any of the net earnings inure to the benefit of any private shareholder or individual. And this is any person having a personal or private interest in the activities of the organization. So, wait, I thought there were some examples, but I guess not. Looks like we're going to have some examples later. Sorry about that. So, influencing legislation is not permitted, recall. So public charities may not attempt to influence legislation, except that actually they can if they're willing to pay a tax. So if they don't make a 501h election, Then there's a 5% tax that would be applicable to lobbying costs. And the potential is they could lose their exempt status. So lower tax, but you could lose your exempt status because basically you're not telling the IRS that you're engaged in this sort of activity. So if they catch you a 5% tax and if they find out that you're not operating primarily for the purposes of your exemption, then they'll take away your exempt status. So the alternative is, let's take a risk-averse approach. Okay, you make the 501H election. So now the tax goes up to 25% of the tax on certain amounts of lobbying costs, but you're not jeopardizing your exempt status because you're basically saying, look, I'm putting you on notice. Hey, we have these sorts of costs and I'm going to report them to you. And so you can see in the annual reporting for an exempt organization, you're required to complete a schedule because you've made a 501H election. So you're reporting what your lobbying costs are. And we're not going to break down like the tax and how you calculate the tax on lobbying costs, because that's definitely not going to be part of the core part of the CPA exam, or there's absolutely no reason to believe it is. It's more of that you understand that these excess lobbying costs would be subject to taxes. But just so you know how much becomes excess, the total amount of taxes paid on excess lobbying costs for all organizations in the United States was $128,000. So it's a very, very small number. So obviously, to the extent that an exempt organization is mixed up in lobbying, and many of them are, they're making sure that they do the 501c and they're keeping it under the limit that they have to keep it under. All right. So there's also something called an excess benefit transaction. And this is when you engage in a transaction that's providing economic benefit. So it's inuring to someone who's related to that tax exempt organization. So an economic benefit is provided by a tax exempt org directly or indirectly for the use of a disqualified person. So if you're a disqualified person, you got to be careful about what's being given to you. And the value of that benefit exceeds the value of consideration received by the organization. All right, so let's do an example of this. The Church of the Flying Spaghetti Monster sells land that it owns to its head pastor, Bobby Henderson, for 1 cent. It turns out the fair market value of the land was $1 million. Now, the Board of Elders of the church approves the sale because it's so large they would have to anyway. So the first level of tax is 25% and 10%. And that is applied to the individuals, to the disqualified person. So Bobby would owe tax of $250,000, so that's 25% of the fair market value of the land. And each elder would technically owe 10%, but that's $100,000, but that's limited to $20,000. And Bobby is required to correct the excess benefit. So he's required to actually pay the remaining $999,999.99, or else a second level of tax kicks in at 200%, which means Bobby now owes a tax of $2 million. So you can see that what they've created is a penalty structure that's really, really onerous, right? So look, we'll let you operate as an exempt entity. We're going to let you do your thing. But if we catch you engaged in excess benefit transactions, we're dropping the hammer and we're dropping it hard. So what's a disqualified person? That's any individual who's in a position to exercise substantial authority over that exempt organization. And that doesn't matter what their title is. So a person exercises substantial authority if they're a voting member of the governing body, if they're a president, chief executive officer, or chief operating officer, if they're a person with a material financial interest, if they're a founder, if they're a substantial contributor, if they have shares or authority to control or determine a substantial portion of the CapEx, or they own a controlling interest in the organization. So the individual does not actually need to exercise influence. It just needs to be in a position to exercise the influence. So a large source of excess benefit transactions is compensation. Because the reality is a tax-exempt org may pay reasonable compensation to individuals who provide services to it. And the way they're going to look at that is the like rule. They're going to say, look, reasonable compensation is the amount ordinarily paid for like services by like enterprises and under like circumstances. So you don't have to pay a lot of attention to public media to know that, for example, churches are one of the organizations that fall into these traps too often, where you have, and again, I'm not trying to be disparaging of any particular religion or subset, but where you have a priest or a minister or a pastor or whatever you want to call it that operates their own church, and they're paid a ridiculous amount of compensation, and they have a corporate jet, and they have some of these things. Well, this is where you might find excess benefit if you looked hard enough. So very few organizations, as it turns out, pay excess benefit tax. There is a tax on excess compensation. This started in 2018. So they said, look, we know that there's like issues with this and they're really hard to identify. So instead, we're just going to put a 21% tax on any compensation in excess of $1 million for the 5 highest paid employees, period. That's it. So once you're on the list, you're always on the list. So this is very much like the 162M rules. So it could be more than five people, because once you're on there forever. So as it turns out, there were 516 exempt organizations that paid excess comp tax of $210 million in 2021, which that was the latest data I could get from the IRS on this particular tax. So you can see that it's not inconsequential, right? They're $210 million. I mean, look, that's relative to the federal budget. That's not very much. But you can see that 516 exempt organizations are in fact paying this tax. So they're compensating their people more than $1 million a year. There's also an excess endowment fund tax. We'll just glance through this really quickly. It's a 1.4% tax on the net investment income of certain private colleges and universities. We're not going to get mixed up in the limits. 33 universities pay this tax, totaling $68 million. So I don't believe UC Davis is one of them, but we tend to be the prestigious Ivy League schools, if you will, and Stanfords and the Dukes that have huge endowments, and of course are private. And so they pay a tax on their excess endowment income. Now, that was only $68 million in 2020, so and only paid by 33 universities. So all of the exempt entities file what's a Form 4720 to report excise taxes. There are lots of other excise taxes. I would encourage you, again, if you think you might end up in this service area, go take a peek at Form 4720. They're all beyond the scope of what could be on the CPA exam, though. All right, a public charity versus a private foundation. Okay, and I know this is in the GLIDE materials, but I didn't think it was explained very well at all. Okay, so comparable to a closely held charity versus a public charity. So a private foundation is like a closely held charity, if you will. So what are the consequences of being classified as a private foundation? Well, you have a lower limit on charitable contributions by donors. And if I'm assuming you guys covered this in your 211, hopefully you did, but there are limitations on the amount of deduction you can take for charitable contributions for individuals. And to the extent you're donating to a private foundation versus a public charity, those percentages are lower. You are required to make distributions, and you will pay an investment income tax of 1.39%. So you can see it's a little bit more costly to operate as a private foundation versus a public charity. So there is a presumption that all 501c3s are private foundations when they are applied for. So that's not true of churches. Churches get like all sorts of leeway with respect to the 501 code sections. Educational institutions, hospitals, and medical research orgs. Organizations that are broadly supported by the public, and a supporting organization of one of the above. Okay, so otherwise you go in and you're expected to be a 501c3. So what's a charitable, religious, or scientific organization? These are presumed to be a private foundation also unless it's a church or has annual gross receipts under 5,000, right? So if it's a church, boom, you're carved out, right? Separation of church and state. or has annual gross receipts under 5,000. So obviously, if you're very, very small, they're not going to treat you as a private foundation. So again, this is your classic kind of sport booster club kind of thing. Or you notify the IRS that you are not a private foundation, which you would file Form 1023 within 27 months from the end of the month in which you're organized. So basically, they're saying, look, we're going to let you operate for a little while, and then you're going to report to us on a form and kind of demonstrate to us that you're not a private foundation. Okay, so here's the reasons for public charity status. I pulled this out of Form 990 because I just wanted you to see, like, here's where you check the box, right? You say, hey, part one, reason for public charity status. This organization is not a private foundation because and you can see that you go through, like, I'm a church, I'm a school, I'm a hospital, I'm a medical research organization, I'm a federal, state, or local government. And number 7 is the one that we think of, right? So I'm an organization that receives a substantial part of its support from a governmental unit or from the general public. Okay, so boom, now I'm a public charity. So broadly supported is the key language, and in order to be broadly supported, you need to meet both the external support test and an internal support test. So first we're going to look at what kind of support you get externally, and then we're going to look inside because maybe you've built up this giant endowment and you're just supporting yourself with your own investment. So the external support test says, hey, more than 1/3 of your support comes from the public through contributions, grants, gifts, membership fees, gross receipts from admission, sales of merch, sales of services, furnishing facilities that is not unrelated business income. And we'll get there in a second because that topic is a big one to concern ourselves with. So basically, like, look, is 1/3 of your support coming from the public? Okay, good. Then that's what we're looking for. You also have to meet the internal support test. So this says the sum of investment income and unrelated business income is less than 1/3 of your support. So not only does at least 1/3 have to come from public charities, but you can't be self-supporting, if you will, to the tune of more than 1/3. So if you get an unusual grant, and this happens from time to time, maybe you have a small public charity and suddenly they get one giant grant from the government or something, and it just overwhelms their entire budget. You can often, try to exclude that. There are terms in the regulations that allow you to do that. All right, so again, basically there's a reporting schedule that's in the 990, and you kind of calculate your public support and you calculate your investment income, and you can see those percentages. I've highlighted them in red down below, 15 and 17, and you can see that it's like, hey, well, one of them catches it, right? There's a little part down there on 19A, 33rd and 1/3 support test. That's the 1/3 support test, right? It's basically going to say, is that number more than 1/3? Because if it is, we got problems. So again, the disadvantage of private foundation is required distributions, right? Along with kind of some of those other things. So first, there's a tax on failing to distribute adequate amounts. So basically, if you're not using that support for your cause, right? So what are you doing with it? You can't just keep it in-house. So first, there's a tax on failing to distribute adequate amounts. The first level is 30% on undistributed income. At the second level, if you haven't paid it in a reasonable time of it being discovered, there's 100% tax. And then lastly, you would lose exempt status. So basically they're saying, look, you can't form a private foundation, then contribute a bunch of money to it, take a deduction for it, and then not have it paid to support any of your causes, because now you've just created a tax exempt investment entity. And if you do that, we're going to whack you with a tax to the extent you don't distribute your income. So the minimum payout you have to make is at least 5% of assets, the fair market value of the foundation assets not being used to carry out a tax-exempt function, reduced by any debt incurred in acquiring business lease realty by 5%. So think of that as, if you're not paying out 5%, then you got a problem. And the 5% is kind of like, hey, that's a reasonable return, if you will. The investment income tax, this is the 1.39% of net investment income of a private foundation. This is whether you distribute it or not. Doesn't apply if it's been publicly supported for at least 10 tax years or qualified as an operating foundation, which we're not going to get too mixed up in that. In fact, we don't have to get mixed up in any of these exceptions. Just know that there's an investment income tax on private foundations. And again, these would be reported on a 990 PF. 990 is the classic exempt entity annual reporting form. PF, surprisingly, private foundation. Okay, now we need to talk about unrelated business income tax. So this is when an an exempt entity is engaged in a business activity that creates income that is not related to the exempt purpose of the organization. So first off, it doesn't apply if unrelated business income is $1,000 or less. So if it's some nominal amount, there's a little bit of a nuisance because you get a standard deduction against it. Otherwise, there's a 21% tax because exempt entities are largely corporations, and so they're just going to pay corporate tax on their unrelated business income. So unrelated business income is only around if two conditions are present. So the income must be from a trade or business regularly carried on by the organization, and the trade or business must not be substantially related, aside from the need of the organization for funds or the use it makes of the profits, to the organization's exercise or performance of the purposes or function on which the exemption is based. Okay, so basically it's like it must not be substantially related except for making funds to the organization's exercise. So let's deal with kind of what that means. So let's say UC Davis holds concerts in both the Pavilion and in UC Davis Health Stadium. If these are unrelated to education, so for example, maybe Bad Bunny comes to campus and has a concert, that's probably unrelated business income because they're making money and they may even use the money for UC Davis. It doesn't matter, right? It's not part of the purpose or function on which the exemption is based. However, maybe they bring the symphony orchestra or the Dalai Lama or some sort of educational sort of entertainment, if you will. Well, that probably is related to their exempt purpose, which is, of course, educational, and as a result would not be unrelated business income. So obviously, since an exempt organization pays 21% tax, there's a lot of incentive to have your income, to the extent any is created, be unrelated business income. So advertising revenue is generally unrelated business income. So let's say UC Davis publishes a game program for each basketball game. And the program contains advertising for local businesses, such as the official car wash of the Aggies or something along those lines. That would generally be treated as UBI. However, there are exceptions. One, if it's only produced annually, so if you create a kind of an annual report and you take advertising in the back of the annual report, then you'll probably escape UBI. Or if you have a third party manage the publication process. So under this sort of arrangement, the exempt organization would typically license its name and publication rights to the material in exchange for royalty payments, which would be exempt from UBIT. So what this means is Davis doesn't publish the game program. It's outsourced to some other organization who pays UC Davis a license for the right to use its name and its image and all the other things for the basketball team. In order to qualify, the organization must completely relinquish editorial control and advertising control before the payments will be considered royalty payments. Now, depending on what can be earned here, most universities are probably not too likely to release editorial control because you never know what kind of ad is going to show up in there. Corporate sponsorships are not unrelated business income if they're qualified. So they're qualified if there's no benefit other than the use or acknowledgement of name, logo, or products. It does not advertise the products or services, and there's no payment contingent on the level of exposure, that is attendance. All right. So exceptions, unrelated trade or business does not include any trade or business in which substantially all the work being carried out for the trade or business is performed for the organization without compensation. So if you have a full volunteer staff, if it's carried on by an organization that's a 501c3 or a college or university, primarily for the convenience of its members, students, patients, officers, or employees. Or, so these are ors, that consists of selling merchandise, substantially all of which has been received as a contribution. So these tend to cover things like the snack shack at again, youth sporting events, right? So the booster club collects things to sell at the snack shack through donation, and then they sell them. That's not going to trigger unrelated trade or business. They also probably have all volunteer staff as well. The bookstore at UC Davis, because that is primarily for the convenience of its members slash students, that's probably not unrelated business income. Whereas the gift shop at a hospital is probably unrelated business income. Now, to the extent that bookstore sells other types of merchandise that wouldn't be considered, that are, not related to the exempt purpose, I buy greeting cards there or something like that, that's going to trigger some UBI. Distribution of low-cost articles. Okay, so you can distribute low-cost articles for free in exchange for a donation, and it won't trigger UBI. However, what does it mean to be a low-cost article? Well, in 2023, that's $12.50 worth of value. So let's say you make a contribution of $100 to PBS, as they do a quarterly fund drive or whatever, and they give you a free tote bag, and the cost of that tote bag is $5, and its market value is considered $6. Now, why on earth the market value of a tote bag would be $1 more than its cost is beyond me, but let's roll with it. Since this is less than $12.50, not only can the total donation be deducted, there's also no UBI, right? Because remember, there's a quid pro quo on donations. If you receive something in return, then you're supposed to reduce your donation, your charitable contribution, by that amount. But if it's below the low-cost article limit, you don't have to. If, on the other hand, they gave you a free coffee mug for a contribution of $200, and the mug costs $13 with a market value of $16, well, because that's more than $12.50, each mug is actually considered sold for its fair market value. So that would generate unrelated business income of $3 per mug, and you would also be required to inform the donor that there's been a quid pro quo. For their $200 donation, they got a $16 mug, and as a result, the deductible amount is only $184. So the computation of UBTI, this is unrelated business taxable income, is gross UBI less deductions that are related to UBI. So significant negative adjustments can be for things like interest and dividends, royalty income, rental income from real property and maybe personal property, and of course, the classic standard deduction of $1,000. As I mentioned before, if your UBTI is $1,000 or less, you don't actually pay any tax on it. Okay, so obviously computing UBTI is a big deal. Classifying activities as unrelated business income is a big deal. We're just scratching the surface because that's all we really need to do to get through the exam. Again, if you go into this area, I strongly suggest you read that exempt entity IRS publication that I posted for you. So file form 990, as I mentioned before, this is an informational return because remember the excise taxes go into 4720. Private foundations file a 990-PF. If you're small with gross receipts less than $50,000, you file on a 990-N, which is literally just a postcard. If there's slightly larger, if your gross receipts are less than $200,000, total assets less than $500,000, you file on a 990-EZ. Otherwise, you file on a full-blown Form 990. This is due the 15th day of the 5th month. So if you're a calendar year-end exempt entity, May 15th would be your due date. And note, all of your 990 and accompanying schedules are made available to the public. So again, to the extent you're working with these clients, you need to recognize all this information is made public. So your board members' compensation, the compensation for your highly compensated employees, these are all going to be made public. All right, let's do a few questions to close out this video. So of the organizations listed below, which organization could not receive approval for tax exempt status under IRC 501c3? Which one wouldn't be a 501c3? I'm just pausing for a second. Okay, so obviously, things like A, C, and D, you've probably all heard of these. There can be a partnership for a scientific research, but that will not be eligible, right? Because it's operating as a partnership, and a partnership cannot qualify as a 501c. So 501cs can only be corporations, trusts, foundations, funds, and community funds. So partnership is not one of the organizational entities that can be a 501c3. To qualify as an exempt organization, the applicant, I'll let you read this for a second. Take a sip of my coffee. Okay, to qualify as an exempt organization, the applicant must fall into one of the specific classes upon which exemption is conferred by the IRC. It can be a foreign corporation under certain circumstances. It can engage in lobbying activities. We know that, right? It just needs to file. And it can be exclusively a social club. There is a whole separate 501c subsection set aside for social clubs. All right. Private foundation status of an exempt organization will terminate if it So the answer here is A. Private foundation status of an exempt organization will terminate if it becomes a public charity. Just being a foreign corporation doesn't change anything. If it doesn't distribute all its net assets to one or more public charities, oh yeah, no, that's not true, right? It's just going to pay a tax. And it's governed by a charter that limits the organization's exempt purposes. Well, guess what? It better be to be a 501 at all. What is the threshold of public support that generally forces a private foundation to terminate that status and become a public charity? What is the threshold of public support? So the answer here is B, right? More than a third comes from members and the general public. All right, fantastic. Oh, this side is blank. It's not really blank, is it? I put some words on it. Yeah, this is, I was at 199 and I wanted to get to 200 slides. So this is how I did it. Yeah, what is wrong with me? Okay, it was a little bit overzealous on my part. Class is intended to be 230 minutes long, so that would be over a minute per slide, but yeah, that is still crazy. This was a long set of slides and a lot of material. And as I warned you on day one, this is a content-rich course, and this absolutely proved it. So normally we'd have a Q&A, but that'd be difficult to do over a video that's recorded like this. So if you have questions, please absolutely send me an email. Love to hear from you. And I might even open up a week 2 discussion board so that if you have any questions, you can post them in the discussion board in Canvas. All right, guys, thanks for listening.